Thank you. So good afternoon, everybody. My name is Grace Spivey, and I do work at Pierce Group Benefits. And we want to thank everyone for allowing us to be a part of this conference. It's one of my favorite conferences to go to. I hate that we couldn't be in person, but I certainly understand why, and want to thank you for allowing us to be a part of this very valuable session. At Pierce Group Benefits, we do feel very blessed that we're able to partner with 86 of the 115 school systems here in North Carolina, and we're really honored that you put your trust in us to help protect your employees. So thank you for that. And we know that many of the benefits that we offer can be taken into retirement should you choose. So, and for those that partner with us, again, thank you for allowing us to serve you. And for those of you that we don't partner with yet, we hope that the opportunity presents itself in the future. So thank you again for allowing us to be a part of this, and I'll turn it back over to you.
Okay. At this time, Doug, Margaret, are you driving or is Doug driving?
Doug's driving today.
Okay, Doug's driving.
I'm driving.
All right. So, ladies and gentlemen, I give you Doug Mayer and Margaret Hendershot, the dynamic duo.
Thank you very much.
Thanks, Rick.
As Rick mentioned earlier, my name is Doug Mayer. I work with the North Carolina Retirement System, and presenting with me today is Margaret Hendershot. She is the Educational Outreach Manager for the 401, NC 401, NC 457, and NC 403B programs. What we're going to be talking about today is how these two plans, your pension and the supplemental retirement plans, work together to get you to where you need to be in order to become retirement ready. So with that, Margaret, would you like to say a few kind words and tell us about what we're going to be talking about?
I would. Thank you so much for attending the breakout today. Doug and I have such wonderful positions in that we talk to pre-retirees all the time. So we're going to share with you some of the insights to make sure you are retirement ready. Administratively, know that the chat box is going to serve two purposes today. One, to not only necessarily take a look at some of the questions you might have as we go throughout the presentation, but also necessarily to provide you some additional links. It is hard to actually give you a comprehensive, all about your benefits in 1 hour. So we're going to make sure that you have some links should you necessarily like to do additional research in terms of certain areas that you find that would be of interest to you. So retirement readiness is what we're talking about, and we look forward to a wonderful afternoon. Back to you, Doug.
Thank you, Margaret.
Sure.
Again, we're going to take questions through the chat. Now, if you have personal questions relating specifically to you, not general in nature, we'd ask that you send those to myncretirement.com. We'll have an individual counselor respond to you directly to address those, because they can look up your account and answer and address any kind of concerns you might have as it relates to you personally. But we'll be more than happy to address general questions through this webinar. This webinar is designed to be an overview of the retirement system. The goal is to show you where the tools are so that you can do this planning, keep track of your retirement readiness on your own. So today we're going to talk about, when can I retire? What am I going to receive? Different retirement payment options and the retirement application process. So we show this screen simply because retirement planning begins when you're hired. New employees, you need to enroll into the supplemental plans. You need to choose beneficiaries separately for all the plans. The pension and the supplemental plans are separate. They have their own individual beneficiary designations. Mid-career, we're helping you keep track with what we call an annual benefit statement that's available in your Orbit account online. Please review beneficiaries as life circumstances happen. You need to update those or you're going to be paying the wrong person after you die. Periodically increase your contributions in your 401. Margaret's going to help you out with that. And again, we're trying to show you how the two programs, the supplemental retirement plans, NC 401, NC 457, and NC 403B, work together with our pension to help get you on the road to retirement readiness. And then nearing retirement, if you haven't done all this planning throughout your career already, good luck. Now's the time to do it. So I'm going to talk about the defined benefit. This is your pension. We're providing a guaranteed lifetime income based on your salary and service using a defined benefit formula. And Margaret, how does this defined contribution work?
You know, Doug, these retirement plans have many things in common. And so qualified plans by their very nature have certain kinds of features that they share, but they are indeed, in this circumstance, defined benefit is a little different than defined contribution in terms of how the amount of money that you can anticipate is calculated and necessarily access to some of these monies. So I'm specifically going to point out the things to consider, not only while you save, but certainly then at retirement and into retirement that are very unique to these plans. There are indeed benefits for these plans while certainly we're putting the money away, and there's necessarily going to be certain kinds of consequences when we do indeed withdraw the money. So the 401k, the 403b have several things in common, and the 457 has some unique features. So we want to make sure that you're aware of those kinds of things as you put your plans together, as these work together to create the readiness for you. Alrighty, Doug?
Thank you. Just a note, where does your retirement money come from? If you were to get a check for $8.20, and we hope your retirement checks are much larger than that, but for every $8.20 unit of a retirement benefit, $1 is your money coming back to you in the form of pension. These are the contributions that you've made throughout your career. $1.80 of that $8.20 mini check comes from employer contributions made on your behalf, behind the scenes, all based on your gross salary. Your employer is actually contributing an amount more than we are to your retirement. But the majority of the pension benefit comes from what we call investment contributions or return on investment. That would be $5.40 in this example. You're a member of one of the largest pension plans on the planet. We're currently 10th largest in size in the world. We're the 10th largest in North America. We are according to Moody's, the #1 fiscally rated retirement system in the United States. So that means we have enough money right now to pay everybody who's already retired. We manage over $110 billion for the purpose of paying retirement benefits only. This is not part of the General Assembly. It's not the general funds. This is the retirement system trust. Again, enough money to pay everybody who's currently receiving benefits. That's 342,000 benefit recipients per month with a payroll totaling $52 million. So enough money to pay these people for the rest of their lives, enough left over to pay everybody who's eligible to retire. And then as you and I, not yet eligible to retire, as we contribute, continue to work, employer matching contributions, and continued return on investment that will guarantee our lifetime benefits as well. The goal of the North Carolina retirement system is to pay retirees on time every month, but to keep doing that forever. So when can I retire? The North Carolina retirement system will provide a benefit in one of two ways, either an unreduced or an early benefit. Now, unreduced simply means you keep 100% of the formula that we use to calculate that benefit in the first place. An early or reduced benefit, we're giving you a percentage of the total. So the formula is the same for both, but early reduced, you only get a percentage of what you could have had you continued to work for an unreduced benefit. So unreduced, if we're at least 65 years old with 5 years of membership service, you get 100% of the calculated benefit. Age 60 with 25 years of service, also an unreduced retirement benefit. This is commonly referred to as the rule of 85. But I need to make one thing perfectly clear. We do not have a rule of 85. Let me repeat that. There is no rule of 85 in the teacher and state employees retirement system. Now, if you retire with 26 years of service at age 59, you can add the two numbers together, it equals 85, but that's an early reduced retirement. In order for this to be unreduced, you must be 60 and then have at least 25 years of service. So you need to meet both minimum criteria first before the benefit is unreduced. And then any member with 30 years of service will receive an unreduced retirement benefit regardless of their age when they retire. Reduced benefits, early retirement, available at age 60 with 5 years of membership service. You'd get 85% of the formula based on that age. Now, at age 50 with 20 years of service, you can also retire. We would calculate that benefit just like we do everybody else using our defined formula, but then write you a check for exactly half. There is a 50% reduction in the benefit for early retirement at age 50 with 20 years of service. Now, as you get older and have more service, that benefit does increase. But do please keep in mind, if you retire early with a reduced benefit, that's your benefit. It does not increase as you get older in retirement. So whatever it starts at, it stays at. The only increases would possibly be cost of living increases. Those are not guaranteed, and as we all know, haven't even kept up with inflation. So all the eligibility for you, the teacher and state employee, general employee, our law enforcement officers, they're all in our member handbooks on our website, myncretirement.com. Once you do retire, you're going to choose a specific payment option. Now, the payment options are broken out into really two classes. One is what will pay the member for their lifetime, and then what will pay the member, and then a survivor. So we're going to just jump around a little in this list. The first is the maximum allowance. This is the pure benefit formula. It pays the lifetime income for the member. When the member dies, the benefit stops. It's for the member's lifetime only. We have what we call Social Security leveling. So now we're going to jump down to option 4. This is a modified maximum benefit. Now, it is not Social Security now on top of your maximum benefit. It's a number somewhere in between based on how much you tell us you're going to get from Social Security, what your maximum allowance really is, and how many years away from age 62 you are when you start your retirement. We take these 3 numbers, put them in a little machine in the retirement processing section, turn the crank a couple of times, and out pop 2 numbers. What will pay you until you're 62 and what will pay you after. Now, the whole benefit is based on the idea that you're going to apply for early Social Security approximately 3 months before your 62nd birthday. So that when the mechanics of option 4 change the amount the retirement pays you, it's replaced by the amount you're getting from Social Security. So you need to apply in order for the income to remain level. Now, if you don't apply for Social Security, you're going to get a guaranteed pay cut based on the amount of money you told us you're going to get from Social Security when you retire. If you're still working and don't want to apply for Social Security, well, we're going to pay you the post-62 benefit only. If you want to wait till you're 70 to get a higher Social Security benefit, we're going to pay you the post-62 amount. The only guarantee with option 4 is what we'll pay you before your 62nd birthday and what we'll pay you after. There is no formula for what if I do this, what if that happens, what if I don't get Social Security, or what if I don't get it in the amount that I said I was. Doesn't matter. Both of these numbers are determined the day the member retires, and it is a contract. And then that leaves us with survivor options, option 2, 36263. Specifically option 2, this is a 100% joint survivor. We pay the member dies, we pay a survivor for the rest of their life. So we're now paying a benefit over 2 years or 2 lifetimes, hopefully longer than 2 years. But these are modified based on the age of the member and the age of the beneficiary. We use an early optional retirement factor table. It's available on our website should you ever want to go look at it. But you just look up the member's closest age on the top right-hand page. Then you look up the beneficiary's closest age in the column, slide over to see the factor of the particular benefit you're looking for. And then you take that factor, multiply it, or take the maximum benefit, multiply it by that factor, and that tells us how much we'll pay the member, thus how much we'll pay the survivor. So you'll probably notice by doing that, that your younger your survivor is, the lower your benefit will be to begin with. So option 3 is a 50% version. Pay the member more now because we're only paying the beneficiary half. And then 6.2 and 6.3 are further modified versions of 2 and 3. These are called the pop up or revert to maximum. 6.2, 100% joint survivor. Pay the member dies. Beneficiary gets the exact same amount for the rest of their life. But if the beneficiary, the survivor, dies before the member's benefit changes, it pops up to the maximum. And it's then that benefit that's paid to the member for the rest of their life. With option 2 and 3, if your beneficiary dies, your benefit does not change. But there is a spouse provision. It's all explained in our member handbook. And then finally, option 6.3, it's a 50% version. Of course, we pay the member more because we're only paying the beneficiary half. But should that beneficiary die before the member's benefit changes, it pops up to the maximum. And that brings us to retirement readiness. And we've actually researched this. What did we find out, Margaret?
Well, Doug, when we polled the audience, we looked at everyone in the teaser system and we said, let's take a look necessarily to see if our folks are ready to retirement. Now, when we refer to readiness, it's not necessarily not wanting to work any longer. It really is being financially prepared to live for all of your years in retirement. And the experts do recommend, as well as the Treasurer Office, as well as Doug and I recommend, that 80% of your current income should be replaced in retirement. 80% is the goal. Now, you may need a little bit more, you may need a little bit less, but that is indeed what to shoot for in terms of replacement value. So they've looked at everybody in teasers and said, okay, so if our folks have just the pension, as good as it is, and Social Security, they are only 44% likely to be retirement ready. Now, we want you to contrast that with the addition of just one additional piece. And it won't surprise you that if you have additional assets set aside for all of your years in retirement, that you would likely be more retirement ready. So those individuals that had a 401k, a 403b, a 457, any combination of those plans, they were more likely to be retirement ready at that 71%. So these plans really do make a difference. It's one of the reasons that Doug has invited the supplemental plans to do a joint presentation, because they are indeed the piece that makes sure you have enough money for all of your years. I'll tell you, one of the biggest misconceptions when I talk to pre-retirees every day is how long they're anticipating to be in retirement. And it's going to be quite some time. Now, this particular slide is designed to show you what we mean by this. So for you to be retirement ready, you would add up your income sources primarily, and certainly providing the base of your income in retirement is going to be teasers. We refer to the pension plan as the Teachers and State Employees Retirement System, or teasers, and what its anticipated monthly benefit will be for you. Incorporate necessarily your Social Security. If you've not looked at your account, and of course they don't really mail those statements with the green font anymore, right? You'd go on ssa.gov and set up your account. That's Social Security Administration. So www.ssa.gov and set that up. And you have your actual piece of information there in terms of when you're going to retire, what your anticipated benefit is, what necessarily will be your full benefit age, how much will you get if you absolutely wait until the very, very longest time period possible at 70. How much is that going to necessarily add to your overall income? And last but not least, how do your supplemental plans then fit into that puzzle? This is actually what's called then your gap analysis, meaning adding up all those income sources is designed to help you to know, are you on track to replace 80%? Obviously, the sooner we do this, the better it is, the less drastic the changes have to be. Maybe we won't take early retirement. Maybe we got to work maybe another year or two, or maybe we can afford to put just a little bit more away in our supplemental plans to be able to make sure we kind of decrease the gap in terms of making sure we have enough money for all of our years. So we want to make sure you're retirement ready, and these are some of the tools to be able to do that. The My NC retirement statement is going through some revisions, so keep your eyes open, and there's new and exciting things for you. Obviously, you can access that through your Orbit account, as well as if you log into your supplemental plans, there's always a link there on the landing page as well. So what if indeed you do have a gap? Certainly the longer that you have to save, the more likely it is you're going to have a gap. So we don't want you to be disappointed or uncomfortable if you've just started out or you're new to government, that necessarily you might actually see that you're not quite there yet. It's just, you're not quite there. But we want to make sure that you're aware, in particular with some of these kinds of features that you see in front of you, you know, what are some of the uniquenesses of 401k, 403b, 457? You recall that Doug had talked about the pension plan is based on a formula. That's a formula. It's you know, it's this times this times this. Well, the amount of money that you have in your 401k is contingent on how much money you put in your 401k. Alrighty. So when we talk about defined contribution, it's defined, or you can anticipate the amount by how much is actually contributed to it, and then obviously then it's earnings over time. The earlier we start, the better it is. I know you've heard of this before, but compounding certainly provides for you then that additional ability for your account to grow. Now, anyone that's a full-time contributing member to teasers can participate in any of the three plans, the 401k, the 403b, if it's available at your particular school system. And if not, certainly that can be added if indeed you would like to necessarily have the state 403b with the additional retail funds that are available, and also the 457. So now your part-timers or your return to work retirees, and if that's in your future, going back to work, and of course, many folks in our school systems just, it's not really a job, it's a calling. And so, you know, many times they'll come back to work. Doug's going to talk a little bit about return to work rules, but if indeed return to work is part of your retirement planning, know that you can participate in the 457 plan. So if that would be helpful for you, know that there is different eligibility there, not the 403b, not the 457 likely, or 401k, but the 457. Now, I do want to be able to talk to those individuals that are going to be retiring soon. So this is our short timers now. I want to make sure that you're aware that there are kind of eligibilities for these plans also. So just as Doug had mentioned, there might be some years of service needed to be able to get a pension benefit. There's also certain criteria in terms of having access to these supplemental plans. As long as you separate government service in the year you turn age 55 or older, you would avoid penalty distribution in 401k and 403b. It doesn't mean necessarily that you're at Wake County schools and then you go over to Orange County schools. That's just changing employer. You absolutely are separating government service. So you're retiring. All right, you're retiring, and you're at least age 55 or older. Okay, you would avoid penalty distribution. Otherwise, if you do leave earlier, then it's penalty distribution, and you have to wait until 59 and a half in order to have access to your funds without that kind of penalty. And I do want to contrast that with the 457, and this is its claim to fame, the 457. You separate government service, so that's the criteria, no longer actively employed, and you have access to your money at any time. It is not tied to any particular age. It's only tied to your employment. Alrighty, so just to give you an idea, these are different eligibility requirements for your supplemental plan than necessarily your pension plan, but they are indeed certainly then applicable to you in terms of as you own these plans. Now, the next 4 steps are truly designed just to make sure that there's certain kinds of things when we talk to pre-retirees that may be out of sight, out of mind. I know Doug had mentioned about the beneficiaries, and that's an important piece for you just to double check today. Alrighty, so double check today. Put a little sticky note or something to say, look, I do need to double check my beneficiaries, make sure everything's up to date. But also equally out of sight, out of mind might be indeed your investments. How you save when you first started saving may not necessarily be appropriate for necessarily you going to basically retire and live on the money. The investments may need to be different there. So it's important that you know, and I will put in the chat box for you if you don't know who your retirement education counselor is. And I'm one of 18 people across the state. Now, of course, we're all working virtually right now, but you're assigned by county. And so in terms of where you are, you're assigned by county. So I'm going to send a link, and of course it gives you not only who your education counselor is for kind of a checkup, but also necessarily then access to email, access to phone numbers, and access to actually our calendars should you wish to make a virtual appointment. Consolidating investments, the next few steps are really just designed to say, no, you do not have to take your money out of the plan when you retire. In fact, many people are deciding to go ahead and consolidate some of these outstanding plans that they might have into the retirement system in terms of into their 401k, their 403b, or their 457. It does give you additional purchasing power if you're considering buying service, purchasing service, or necessarily if you're considering transfer benefit at retirement to have these assets be as large as they can. And of course, as we look at the next 2 steps, this is just really something to kind of call to your attention. If you've not changed your contributions recently, it is a very simplified process at this point. And the coolest thing ever, if you've not downloaded the app, I know there's an app for everything, but if you download the Prudential Retirement app on your phone, as soon as you log in, and that can be accessed by your finger or accessed necessarily by a code, you can change your contributions in 2 clicks. So it's very, very easy to change your contribution amount. We certainly would suggest, changing them regularly means just small amounts truly add up for you. They truly, truly do. No people will necessarily even set up accounts for final payouts when they retire. But indeed, if you're trying to accumulate assets, while you're employed, this is one of those ways to do it and make it less painful. I will tell you, unfortunately, once you retire, you can no longer contribute to these plans. So obviously the goal for you is to make sure we make these plans as large as possible while we're still employed. And last but not least, the IRS allows us to do that too, is actually supporting us over 50 that says, you're closer to retirement. We want to allow you to put more money into the plan. So there's a lot of flexibility in terms of the amount of money we can actually defer into these plans, because of course you can own the 401k and the 457, you can own the 403b and the 457, and you can maximize each plan's voluntary contributions for this year. Just for your information, are $26,000 per plan per calendar year. I tell you this particularly for our short timers information, because if you are considering deferring your final payouts, unused vacation, bonus, those types of pays, the answer is there is only so much that can go into one single plan already. Now, if you're under the age of 50, $19,500 is still the voluntary contribution amount. So just know we've got lots of flexibility in terms of the amount of money that you can defer then each calendar year. Already, Doug.
These are the supplemental retirement plan features.
They are, as a matter of fact, maybe I could just make a quick comment here in terms of just some of the features of these plans as they relate to necessarily what makes them different than maybe some plans you've had in the past, because they're provided by North Carolina. And so you've got the benefit of oversight of not only the treasurer's office, the treasurer himself, the board of trustees, their financial advisors. They met just actually yesterday and go through each and every area of the plan in terms of the operations, the investment funds. This is all part of the operations and the oversight provided to you in terms of owners of each of these accounts. Do know there has been a true focus of making sure that the fees are very, very competitive. And so you will find this to be a very, very low cost plan. In retirement, it is truly not what you make, it is what you keep. If you don't have to pay the fees, you get to keep the money. Alrighty. Know necessarily the investment options that are available. And of course, we know that there's multiple options in terms of funds. But also necessarily, there's other things that you can do as well in terms of choose your own funds. And of course, then there are unique opportunities once you own these state plans to transfer them to the pension fund for increased payout. We call that transfer benefit. Chad, I will mention, as Doug is changing the next slide here, that just love the way you think. We want you to be able to contribute to your 401k after you retire. We would just love that, but you cannot. You can only be an active employee. An active employee can contribute to these plans. And so that is one of the reasons we want to make sure and encourage you to do what you can to keep these plans, in mind, in terms of being able to defer that. So should you necessarily have pays throughout that, maybe you could put a little bit more in. There's ways to do that. It's just a form. You're not surprised by a form. It's called the one-time contribution form, where you can maybe throw a little bit more money in, and then it goes back to what you're normally doing. You can certainly change your contribution amount too, but very, very good question. Thanks so much for that. Goalmaker is actually the portfolio that's available for you if indeed you want some investment help already. So when we think about Goalmaker is something that says, we know most people know they need to save for retirement, but probably the biggest challenge is necessarily, choosing the funds themselves. They're not necessarily really comfortable with that. So this is the help. This is the investment help provided in these plans. And these are unique to target fund or asset allocation type of funds, in that if you answer the question necessarily, how comfortable are you with risk in terms of your investor style? Are you conservative? Are you moderate? Are you aggressive or growth oriented? And then how long before you're going to need your money? It will help to necessarily provide for you then how your money should actually be divided. So it helps you to get to that goal. It helps you to get to that peak in terms of making sure that you're set and that you have the funds that you need to, based on the goals of necessarily the funds when you retire. Alrighty.
Okay, and then very quickly, we're going to talk about death benefits in the North Carolina pension plan. If you die as an active employee before you've retired, or within 180 days of terminating employment and not retired, if you have named only one single individual for the return of contributions primary beneficiary. Now, you can have contingent beneficiaries, but you need to have only one primary for the return of contributions. If this is the case and you're at least 60 years old with 5 years of membership service or 20 years of creditable service, regardless of your age, we're going to offer that one surviving beneficiary that you designated for the return of contributions a lifetime income. It is the survivor benefit of option 2, 100% joint survivor, calculated just as if you had retired versus died. Now, it is up to the member to make that decision, but that's only offered if there is only one single living individual named as the primary beneficiary for the return of contributions. If you have a trust, your estate, or multiple individuals, the offer is never made. The return of contributions only would be the benefit. Return of contributions, if you have chosen a retirement payment option or decide to withdraw your contributions and not retire, your money is always yours. It's available. A return of contributions upon your death also occurs if you are a retiree. So that's called the guaranteed refund. And then we got a death benefit for active employees that is a minimum $25,000 up to a maximum $50,000 benefit paid to the beneficiary or beneficiaries that you choose based on your highest salary earned out of the last 2 years, but it's a minimum 25 capped at a maximum of 50,000. If you die as a retiree and you chose the survivor option, 2, 3, 6, 2, or 6, 3, the continued lifetime income to that beneficiary is your death benefit. Now, the active death benefit we spoke about earlier does continue for 180 days after terminating employment and can even continue into your retirement. All retirement payment options do have a guaranteed refund. Now, for the maximum and option 4, that one's pretty easy to figure out. When you die, we look at your account. If there are any remaining undistributed contributions, that's your contributions and interest at retirement, minus the month checks we've paid you up to that point. If there is any balance remaining, that is paid to the guaranteed refund beneficiary that you chose. If you had a survivor option, 2, 3, 6, 2, or 6, 3, we're going to wait till the survivor dies as well. But we'll look at the account balance. If there is any undistributed contributions and interest upon the death of the survivor, that's paid to the beneficiary that you chose for the guaranteed refund while you were still living. And then every retiree is offered the contributory death benefit. This is optional. You're paying the premium. You choose whether or not to have it. You designate the beneficiaries, but it's based on a premium determined by your age when you retire that never increases. The death benefit itself is $10,000 and will never decrease no matter how old you get. However, we do need to see that premium deducted directly from your retirement benefit for the first 2 years before the full $10,000 benefit is paid. How do I retire? Well, here it is. You log into your Orbit account. The second choice in the menu on the left is Retire Online. You click that button, answer a couple of questions, hit submit, you're retired. Now, you can do this 120 days before you retire, so you still got some time to work it out with your employer and all of that. This is not a surprise your employer, I'm retiring tomorrow, option specifically for members. This is designed for convenience. You and your employer. Now, 24 hours after you hit that submit button, we're going to email your employer and say, hey, you've retired. Fill out this information so we can calculate the benefit. So they're going to know. The whole process is broken down into 3 steps. It is simpler, more concise, and you get questions answered along the way through a little help box that's right next to every question we ask. The whole process is done online, with the exception of one form. It's called the Payment Option Election Form. That's the end of step 2. So you start, you continue, you answer all the questions in step 1, you hit submit, and then you wait till we email you, then that tells you, okay, we're ready to have you go to step 2. So we've calculated your retirement benefit based on all the information your employer provided. And now you're going to choose your payment option. Well, this form you need to print off because you're going to choose that payment option, print off that form, sign the form, and have it notarized. You can scan that back into your account and upload it into your online retirement process. You can attach it as an email to myncretirement.com or myncretirement. Oh, NC Retirement at nctreasurer.com or fax it to us. You can even fold it up and stick it in an envelope and mail it to us. But it's this form that finalizes your retirement. It also opens up the ability to change your health insurance. And then steps 3, take care of everything else. It's online as well. Setting up your bank account information, beneficiaries for the contributory death benefit, and the guaranteed refund. Again, that's all done online. The paper process does still exist. So if you start retirement online, you're going to stay with that through the entire process. If you start with the paper process, everything is done through the mail. It remains the paper process. So whichever one you start, you will finish. With the online retirement, you get a little roadmap so you know where you are along the way. Retirements are always effective on the first day of the month. An application should be submitted as soon as possible, but not more than 120 days before you retire. If you send it in too early, we'll send you a letter that says send in a new one because you sent the first one too early. Now, you also have up until the day before you retire to submit a retirement application. Now, I can guarantee one thing, you're not getting a check for 3 months. It's going to take 90 days to turn that retirement application into your first retirement check. It does not matter how big you write on that application, I'm retiring tomorrow. They are done in the order they were received. Your first retirement payment is always mailed. This is a paper check. I call it the reality check. You're going to open this check where you open all your important checks and have one of 2 reactions. Gee, this is terrific. I should have done it years ago. Or, oh my gosh, I can't live on this. If there is a problem, do not cash that check. Call the retirement system. We'll see what we can do. Now, paydays are on the 25th of every month, unless it falls on a weekend or a holiday. Then we'll pay you the business day before. Health coverage. Now, this is where that Form 6, choosing your payment option, 6EOL is what it's called. This is the one you print off, have it notarized, send it back if you do the online process. If you're doing the paper process, we'll mail one of these to you. It still needs to be notarized. But it's not until this form comes back to the retirement system that the little option in your Orbit account called eBenefits Now becomes available to change or modify your health insurance. Now, you will be automatically enrolled from whatever plan you have as an active employee into that same plan when you retire. Now, if you've opted out of state health plan, we're going to automatically enroll you into the 70/30. Now, if you've got the 80/20 family, everybody on their plan, you're going to have the 80/20 and we're going to bill you the respective premium once you retire. So it's called auto enrollment. This works fine for everybody who's under the age of 65. If you're over the age of 65, you need to start your retirement plan early. or we're going to auto enroll you into the 70/30 plan, whether you want that plan or not. Now, there are other options available to age 65 retirees and older that have Medicare Part A and Medicare Part B. They're called Medicare Advantage plans. Now, there's a Medicare Advantage Basic and a Medicare Advantage Enhanced, and the Enhanced typically has similar benefit coverages as to what's available in the 80/20 plan when you were still an active employee. So you need to go to SHPNC to see the details of these different plans. The state health plan itself has its own 90-minute webinar. It's kind of hard to stick their webinar into our regular one, and let alone one that's only 60 minutes. So you need to go there. You can also sign up. They have, you might have received this in the mail, a smooth transition to Medicare. They have retirement planning seminars for the state health plan twice a month, all year long. You just go into www.shpnc.org and click on the tab called Outreach Events. And then, of course, there's the Pierce. They're providing optional dental, vision, and identity theft coverage for retirees. Now, if you already have the Pierce, this coverage may continue uninterrupted. But for the majority of our active working population, whatever benefits you have as an employee will terminate the day you terminate employment. Again, replace those coverages with the dental and vision through the Pierce Insurance Agency. But if you are, say, working on a current dental plan and you're getting a certain treatment and you terminate, well, that coverage is going to stop, but you can continue with that through COBRA. So Margaret's going to paste this link into the chat area. These are the programs available through NC Flex. There's a list of which ones are available to continue through COBRA continuation. So you could continue these coverages for 18 months after you terminate employment. But after that 18th month, it is over. That brings us then to the optional transfer benefit. Now, this is not the one-time contribution Margaret was talking about earlier. This is after you've done all your one-time contributing. And of course, you can do that more than one time. After you've done all the transfers of annual leave payouts and bonus leave, all of that, filling up your 401 or 403B to the maximum, you can take that account, the NC 401K or the NC 403B, no, excuse me, the NC 457, and transfer all of it or part of it, part of each, or one or the other, or both, back to the retirement system for an additional lifetime monthly benefit paid to you over and above your pension benefit. But again, this is a transfer. You're trading an asset for a lifetime income. Is this a good idea for everybody? No. But we've got some resources. Margaret, can you share with us some of the resources available to help people plan the transfer benefit?
Yes, indeed. You know, the transfer benefit is a unique opportunity where you can take assets that you've accrued then through your 401k, your 457 account, and actually send them over to Doug. You could, not him personally, but you can send it over to the retirement system for a separate check with separate kinds of decision points. Should this be something that you would find of interest, I do want to highlight this might be a good screenshot, although you will be getting this presentation, as a copy as well. you would start necessarily with your NC Plan's website to make sure you know how many assets you have, how much money is in some of your accounts. And what does that necessarily then mean for you in terms of an actual dollar figure? And that is where I can't stress how what a wonderful resource the myncretirement.com site is, in that it does indeed provide estimators for transfer benefit, purchasing service, as well as calculating monthly benefit. So the answer is, it's important for you to know what indeed a 401k means on a monthly basis when it comes to assets. If indeed that's something that you are still interested in after those numbers, this State Employees Credit Union nclifetimeincome.org site is very, very helpful, in that if indeed you need clarification on the drop-down boxes in the estimator, it talks in very clear format what decisions you're making and why necessarily that would affect your benefit. So just know these are only available from North Carolina plan. So should necessarily you have an outside retail plan, it would have to then go into the North Carolina plan before you retire to be able to affect this benefit. Alrighty.
Thanks, Margaret.
Sure.
And of course you can consolidate. That's what Margaret was talking about a little earlier, transfer other assets into these NC sponsored programs. And then what do we do after we retire?
So as we wind up, because we do want to allow a few minutes at the end, so in case there's any other questions that you might have, this is actually just a summary of what are some of the benefits of necessarily maintaining your account with the North Carolina plans. There is a misconception that once you retire, the money needs to be withdrawn, or once you retire, the money needs to be put somewhere else. And certainly know that is not the case. The money can stay in the plans, continuing doing what it's doing. Now, the next slide is designed to let you know too, there are options when you retire in terms of the kinds of things that are available. You can keep it in the plan and keep it as a nest egg. And this seems to be the really popular decision now, that we know if we retire in our 60s, we are likely necessarily to need this money for decades. Once we do indeed sever government service, I mean, we're no longer employed, that is a trigger to allow you to put the money somewhere else should you wish. And of course, you also can begin taking money out of the plan. That's what they're for. You can take them as needed. You can take them monthly, quarterly, yearly. This is truly the big, big advantage of these plans. This is the big advantage in that you get to decide when, you get to decide necessarily how much. And so there are indeed going to be requirements from IRS that you're going to have to take out some little bits of money by what's called required minimum distribution age at 72 now. But for the most part, you decide necessarily when things take out. And of course, then there's also the transfer benefit. The transfer benefit is there for you at retirement or later, should you wish. Alrighty, Doug.
Okay, quickly, what do we do if we come back to work after we've retired? Now, these rules only apply to coming back into the retirement system from which you retired from. So we're going to focus on the teacher in state. There is a 6-month break in service after you retired before you can come back to work. Now, you can be a bona fide volunteer in a public school. You can be a bona fide volunteer somewhere else. You can be a guardian ad litem, which is helping a juvenile navigate the North Carolina court system. You can become a board member on the UNC system or any of their constituent institutions. You could be a board member of your school board. You could be on the board of the Soil and Water Conservation District of your county. But other than that, service is prohibited during the 6-month break in service. Now, specifically, you cannot volunteer to come back and do your job for 6 months until it becomes available for you to get paid as a return to work retiree. Also, pre-existing agreements for post-retirement hire are prohibited. Now, after your 6-month break in service, you can come back and be a member again. Keep the 6 checks we sent you up to that time. We'll send you one more for good measure, and then you get to become a member again. We'll suspend your retirement until such time as you retire. Or you could come back and work under what we call the earnable allowance, where you work in a non-contributory position, part-time, temporary, interim, contractual, or any of the above, where membership is not required. Now here you're allowed to earn up to $34,800 per year, or 50% of your last 12 months compensation, whichever is higher. But if you earn too much, we're going to suspend your benefit the month after, and it won't start up again until January of the following year. Health insurance will resume on February 1st. Online resources. Now, Orbit is the place you want to go. Look at your account information. All of your history is in there, as well as all of the retirement planning tools. Retirement estimator, service purchase estimators, transfer benefit estimators, your retirement statement is in there, as well as the online retirement application. And you're going to keep your Orbit account as a retiree. Here you're going to be able to review the benefits we've paid you, change tax withholding, change your bank information. You can even update your address if you move to Florida, view 1099s. There'll always be a copy of every one we've ever sent you, and generate income verification letters. This is what you see when you go to Orbit. To log into your personal account, we need a username and a password. If you forgot them, please use the username and password help icons on the left. If those are not successful, call the call center. Once you've successfully navigated, you can either use the menu or the green tiles. And here's just a snapshot of the custom benefit estimator. It is really very easy to use. Just answer all the questions, hit calculate, and it's going to tell you your monthly retirement benefit. And then Prudential has some online tools as well.
I certainly just want to mention very briefly, the retirement income calculator is available from your by logging into your account. And this is actually a tool that's a little bit more customizable than the annual benefit statement, in that you can input, after you've done your estimators with your monthly benefit, you can input your pension benefit, you can input your Social Security anticipated amount, and it will give you then a much, much more accurate projection of, are you retirement ready? So be comfortable. If you're not comfortable with the tool, then by all means, reach out to your retirement education counselor. This is something available for every person on the call today, because you want to make sure that you're retirement ready when you really do want to stop working.
And then just a couple of reminders, beneficiaries are separate, and please create your own account, my SSA account at ssa.gov. The last time we worked with Social Security, their reason for this was, please do it before somebody else does. So that's a good reason. Online resources for the retirement system, of course, the member handbooks. We've got videos on how to do everything, specifically how to get back into your Orbit account if there's ever a problem. Here, we're just sharing this information with you. This is the NC ABLE program. It is administered by the Department of State Treasurer, the same administrator as the retirement system. But if you are the grantor or caretaker of a disabled individual, or you know someone who is, this program is designed to allow you or the grantor of someone else to contribute funds for the future benefit of this disabled individual. But it does not currently affect whatever benefits they're receiving. So it's a good program. Again, we're not going to be here forever to support whoever it is we need to. So it's a good program to put assets aside for the care of disabled individual. Margaret, if you could please paste the Survey Monkey tab into the chat box, I'd greatly appreciate it. It would take you longer to type this in than it would to take the survey. Our information and to get into orbit is myncretirement.com. That's www.myncretirement.com. Email us, nc.retirement@nctreasurer.com. You can also contact us through your Orbit account directly. Just click Reach a Counselor. In fact, you'll even get your answer sooner because we already know who you are. And the call center is open. It's 8:30 a.m. till 11:30 a.m. They close for lunch for an hour and then reopen at 4:30 Monday through Friday. Fraud and Abuse Hotline, 855-903-7283. And then our mailing address, 3200 Atlantic Avenue in Raleigh, North Carolina. Please remember, the office is currently closed to visitors. Until such time as we reopen, we'll be happy to accept your mail. But if you need an appointment, we're going to do it online. We do virtual appointments. Prudential does virtual appointments. We'll even do it on the telephone. But that's it.